growth versus cash flow. The age-long debate of where you should put your money to get the best returns on investment. Let's face it, as a property investor, we want it all. We want capital growth, we want cash flow, and we want a touch of upside in the next 2 or 3 years so that we can really leapfrog into the next property deal. Can you still get that in this market? And should you be investing in regional or metro areas? This is what this video is all about, and about giving you the criteria and the profiles of the property you should be looking for, or the areas in metro and regional that you should be investing in. So really tune in. But if this video is of relevance to you and you really enjoy the information, make sure you hit the bell and subscribe, and make sure you click in for that free strategy session where we can help you build out a sustainable portfolio and get you to financial freedom through commercial property utilizing our buyer's agency service. Now, one of the key things to invest in property of any sort, doesn't matter if it's regional, metro, residential, or commercial, boarding houses, or anything of this, or NDIS, anything else, is to look at the return in investment. To compare regional versus metro, not only do you compare it now, which most people compare it now, but never look forward long enough to compare it what's going to happen the next 3 to 5 years. Now, often that's because most buyer's agency out there haven't had the track record of 3 or 5 years like we have. We've been in the commercial buyer's agency space since 2016, where most buyer's agency out there are 2 to 3 years old, and they can't tell you the history of where, let's for example, where Mackay has been, where Townsville has been, where Warrnambool has been, where Geelong has been, where Newcastle, Wollongong, or any of the areas around Brisbane have been 5-10 years ago, and we can do that. Now, we track properties and how they perform on a daily, weekly basis. We watch auction results, we track leasings, we track trading history so that we know how you can get the best value in the market. And really, the key to the best value in this market is undervalued properties. Now, how do you get your hands on undervalued properties? Should that be in regional or metro? Are we seeing more of it in metro versus regional? The key to that is stagnation. Study stagnation. Now, why is that important? Let's have a look at this example. In 2019, we bought a property for a client in Townsville. Now, but at that time, most buyer's agents haven't even come into Townsville yet. Now, we were buying properties at 8.5%. This little warehouse property we bought was sub 1 mil, and it was 8.5% yield for our client. It was a flooring showroom space which had a warehouse at the back, right? It was a good little property, and just earlier this year, the client sold this property for 1.1 million. So over the 5 years she's held it, she's got 30% growth over that year. Right? So 30% growth over that time. Plus, she's picked up a whole heap of cash flow. Because if you remember, in 2019 to 2020, during that time is when the interest rate came down. During COVID, we hit interest rates at record low rate of 2% to 3%. So she was making at least $40,000 to $50,000 passive income on this property every year while picking up the capital growth. That's having your cake and eating it too as well, right? Now, if we want to go back into Townsville today, these type of properties trading between 6.5% to 6.8%. You're not going to get even 7% for this similar type of properties. So should you still go into regional areas? Now, you can still go into those regional areas, but it may not be Townsville or Mackay. It may not be a Rocky. It may not be a Sunshine Coast, because those areas have boomed. If you are planning to go into those areas because they're much more secure with large populations, defined growth, some transparencies and trading history, if you want to do that, then one of the key things you need to look for is the undervaluedness of the property, and you may need to go up a bracket. So instead of buying 1 million, if you can push yourself to 1.2, 1.4, you're going to be able to take out some of the competition, and you're going to be able to look at properties that potentially not yield at 6.8%, but maybe 7 or 7.1%, but maybe you even find a property at 6.8% that has some rents that's under market, then in the next 2 years you can lift the rent and get you to over 7% and moving forward. So that's the undervalue you need to look for if you are going to these large areas. The key gems is to look at areas that have not had that growth and have that some stagnation, but are about to take off. So some of these can be offshoots of these areas. So for example, around the Wollongong area down south in Sydney, areas around the Shell Harbour, around Nowra, Port Kembla, all of those places where it's an offshoot from the main hub. It works really well because they've had some growth, but they hadn't had phenomenal growth because that's still underlining coming to God. That gentrification, that change is still coming, but there's heaps and heaps of developments and heaps of commercial properties that's are going from old to new. And those areas are good areas to keep an eye on, because you can still get into those properties at good yield, higher than you would in those central metro areas or central areas of regional. And they won't be 7%, but you could get them there in 6% versus a 5% in around the Wollongong area. You get 6%, maybe even 6.5%, which means you are already doing well in your cash flow, and then your growth will come in the next 2 years. So if you're looking at regional, those are things to think of. So think of, like, for example, Newcastle, and then think of Wallsend, like as an offshoot. Think of Maitland, think of Singleton, right? Those areas where they haven't had exponential growth, but have had growth consistently, but will take off in the next few years, because as people push out and look for more and more areas to invest, those areas will be the first hit. So if you are investing in regional right now, those are the key areas to look for. If you are going to metro, the one thing you need to know is that you will be negative starting out. And the reason you'll be negative starting out is because the yields are still holding tight at somewhere between 5 to 6%. If you can get to 6% in metro, you're doing really well. But I've seen properties at $7-10 million where they haven't hit at 6% yet, especially in industrial properties. In industrial properties in areas of Melbourne, Sydney, Brisbane, in Brisbane, you'll hit close to 6%, but mostly in Melbourne and Sydney, it's going to be 4.5% in Melbourne and sub 4% in Sydney. So sometimes it's not even worth buying those properties because you're going to be negative. So is it worthwhile to actually invest in metro? Now, this is the key. There's certain areas in metro that are underperforming, right? Especially because investors have left because of COVID, because of government taxes, because of just the attitude of the investors thinking it's all too hard, and the residential have consistently gone down the last 2 years while they saw other cities go up. So those areas we've seen are your Melbourne, your ACT, and we've just started to see the inkling of South Australia starting to pick up. So those 3 areas are those undervalued areas where, yes, your cash flow is not going to be great, but your capital growth in the next 2 years will be actually really phenomenal, right? You just need to hold out for it. So it's like imagining getting into Perth 4 years ago versus getting into Perth now. So getting into those areas is like getting into Perth 4 years ago. So Melbourne, parts of South Australia and ACT, because they're hitting the bottom of the market and they're really struggling at the bottom of the market before they pick up. And there may be another 6 or 9 months before they turn, and you get some growth, and then all of a sudden it will take off and you'll have a good 12 to 2 years of solid growth out of those areas. Why do I know that? How do I know that? Because here at Unikorn Commercial Property, we work with a team of experts who monitor the market, watch the market, and basically learn what people are buying so that we can predict what the future growth of that area or that property will be. So if you want someone who can give you transparency and clarity in your investment, plus a strategy and a blueprint to move forward, you need to connect with us below on a link to booking for your free strategy session where we can map this out for you. Let's dissect this. Let's say you're buying a $1.5 million property. And the reason we chose 1.5 million is because it gets you away from the everyday investor, and you have a little bit more breathing room than everyone else, potentially getting a little bit higher in returns. And these properties still hard to find, but in comparison to an $800,000 property, it's a little bit easier. So let's have a look how that works if you were buying in regional versus in metro. So let's say we're going to regional. Now we know in regional, when you're trying to buy a freestanding building that either is an office space or a retail space, you're looking at around a 7% yield, but for this argument's sake, we're going to call it 6.8% because we're not always going to get 7%, but if you get a really good property with a good tenant, it's worth trading a little bit of yield for that quality. 6.8% means it's $102,000 in terms of net rent. Now remember, in commercial, the tenant pays all the outgoings and you end up with the net rent, which is the money that you get in your pocket at the end of the day paying your mortgage. Now, if you're financing this property at a 100%, so at 6.75%, if you're actually financing this property, you're going to be just on breaking even. So you're paying for the cost of stamp duty and everything else, and so you're going to be just breaking even because you're getting 6.8% and your interest rate is 6.75%. Now, if you get fixed or if the interest rate comes out, you're going to start making money. So that property breaks even for you. So it's no stress on you. You don't have to service it. Nothing happens. You just basically buy the property, let it trade, service itself. wait for the rate to come down, pick up the cash flow, wait for the growth to happen, and then refinance and go again. Stress-free investment, right? Easy peasy lemon squeezy, right? Now, if you were to do the same in Metro on that $1 million property, you're best going to get 6%, right? Most of the time, you're probably going to get a little bit shy of 6%, but let's call it 6%, which is nice round numbers, $90,000 in positive cash flow. Now, if you were doing that in metro areas, Sydney, Melbourne, Brisbane, you're going to need to put some cash in, because if you don't put cash in, you're going to be negative. So when I talk about 100% borrowing, I meant that you're drawing down the equity from either from your home, your principal home, or from an investment property. By doing that, what happens is then you end up with there is an interest component to the deposit plus an interest component to the commercial property. So together, you actually end up with 100% finance. Costs and everything else you're putting cash in for. So 100%, $90,000 is your net rent, but remember your repayments are going to be somewhere around that $102,000, $105,000. So you're going to be negative around $12,000 to $15,000. So that's going to have to come out of your own pocket to service it. Now, if this property is going to have exponential growth, which means that it's going to double the growth you would get in regional, then it may be worthwhile to get it, because for every $10,000 you put in as negative, you might be picking up an extra percent on the back end in terms of growth. Now, extra percent on 1.5 million is $150,000, right? So every 1% that you get on the back end is a $15,000 on 1.5 million. So every time you're negative by that 1% you're putting in, which is that 12 to 15% that you need to put in, having an extra percent on the back end makes up for it. And you got to do the math if that works well for you or not. Now, you would only do that if the growth in that area actually doubles the growth you would have in regional, right? Because regional, remember, it's stress-free, it's out of your own hands. Remember, investing in regional, it's stress-free, it's not reliant on you, and you basically sit back, wait for the property to churn and break even. When the interest rate comes down, you get positive cash flow. So then that property is going to have slightly less growth. So let's say in regional, you get somewhere around 3 to 5% growth. Now in metro, you are going to be negative 12 to 15,000, but you are going to be getting somewhere around 5 to 8% in growth. Yes, you do get that in commercial property. You get that in residential. You absolutely get that in commercial, sometimes a lot more as well. So your 5 to 8% in the commercial property is going to mean that the extra 3% at the back end that you would get versus the 3% less you're going to get in regional is going to actually mean that you can buy faster. So there is two train of thought. If you are looking to retire really soon, then the cash flow property works really well for you, and you should be investing in regional areas. You'll break even now on 100% finance, but as the interest rates come down, you get more and more cash flow, allowing you to support the rest of your portfolio, make it hassle-free for you, more set and forget, and you can sail off to the sunset sooner. However, if you are young and you can service, then a property in regional may not serve you well. What you need is a property that is going to give you growth so that you can refinance against it and buy sooner again. Now, that having an extra 2 to 3% on the back end means that every time you're negative 1% in the front, which is that $10,000 to $12,000 on the $1 million purchase, you're picking up $30,000 to $45,000 in the back end. So you're tripling the money you would make on the back end. So it's worthwhile for you to trade that negative for that growth in the back end. However, the key differences in commercial versus residential is that that trade will only be around about 1 or 2 years, but only in cash flow, not in growth. You see, this is the interesting thing. If you are negative now by 12 to 15,000, the moment the interest rate drops from 6.75% to 6% over the next 12 or 18 months, then you're going to find yourself not only breaking even, but making cash flow as well. And at that point, you're also picking up your growth. So you're almost setting yourself up today to have cash flow and growth in the next 2 years. So having your cake and eating it too, you just have to wait and have that delayed gratification in 2 years' time. So when I say that with that trading, that negative for the growth on the back end, it's only going to be 2 years, what I mean is you're only going to be negative cash flow for 2 years versus being negative cash flow all the time when you're buying a residential property. Now, we come back to dissecting, is buying regional better than buying in metro? Now, If right now, if you're asking me to pick, I would say you need to buy in a metro area, be slightly negative, because remember, planning for property investment is about the long term, where you want to be in 2 years' time. And if you are a little bit negative in your property investment right now, it means that you're only going to be negative for the next 12 to 18 months until the interest comes down. And then you're going to be positive, but you're also then going to pick up on the growth of the property market, which means that you'll then be in a really nice position to have both cash flow and growth. And all of a sudden, when you have your cash flow, you can then leverage off your growth sooner to buy again. Whereas in regional, you're going to have more of that consistency of cash flow. So if you're looking for consistent, regional is the place to be, because it's had such a good run in terms of growth in the last 4 to 5 years. It may be a little bit more stagnant coming up. However, it will give you that consistency of cash flow if you're looking for that for stability. But if you're looking for being able to buy again faster, then definitely metro is the way forward, even if you have to be a little bit negative right now. Because remember, being negative in the commercial space is a moment in time and not forever, like in residential. If this video has been of interest and now it's given you a bit of a pathway to see where you should be investing, then make sure you subscribe, share the word around. Join us in one of our upcoming events. We've got meetups, we've got live events, we've got virtual boot camps, loads of things. Make sure you check us out on our website, book in for that free strategy call, and I'll see you in the next video.